Good morning. It is Tuesday, April 5th, 2022. We've got a lot today to go through. One quick programming note, we will not have a call on Tuesday morning. That's next Tuesday, April 12th, because we will be having our macro presentation at Third Door. We'll also be broadcasting it on Zoom and on replay if you need to access it that way, but we'd love to have you in person. Leading up to that, as I have not started to prepare the slides yet, I would be very interested to see if there are questions that any of our audience has. Please email them to us, just text them to us, send us in the chat, and we'll be happy to hit on those questions either in these calls or at the macro presentation on Tuesday. Tom is back from a day at the Masters, and he didn't get a chance to talk about this yesterday, but I know he's a big Twitter file. And Elon Musk, we talked about him buying a 9.2% stake in the company yesterday. Today, Twitter has said, instead of having a proxy fight and fighting with Elon Musk about being added to the board or not, we'll just add him to the board regardless. So Elon Musk is being added to the board of directors at Twitter. Tom, do you think this has an impact on Twitter itself? And do you think that this is a smart move from Elon, or is he spreading himself too thin?
I think it's an interesting way for him to affect the change that he wants to have. He put that Twitter poll out saying, hey, should there be more freedom of speech on Twitter or not, essentially. And it was an overwhelming yes, saying that there was obviously problems with how Twitter was run in terms of what could be said and what couldn't be said. And I think Twitter sees the writing on the wall. I think they know that this could kind of go one of two ways, which is one, they can welcome Elon Musk with open arms and let him be heard and influence the company, as now he's one of the major shareholders, or he's got enough money and enough brain power at his disposal that he could potentially launch a new platform that could just make Twitter obsolete. And it's even possible, and this is sort of a third scenario that I was thinking about yesterday, is it's possible that he has basically pushed himself in. He knows that's going to move the needle. That's going to raise the price of Twitter. He can be in there long enough to figure out exactly how they run Twitter and what is going on with Twitter. He can sell, make a profit, and turn around, and then launch his own competing platform. So I think that's sort of the three ways it could go. I think it's a very interesting way to do things. I think Elon Musk is a shrewd guy, and I think that if he is essentially being, I think he's been lumped in with sort of the Joe Rogans of the world, where that people think he's a little bit radical. He's sort of been ignored by the Biden administration, where they talk about electric vehicles. They almost always specifically don't mention Tesla as one of the leaders in the electric vehicle space, and I think that annoys him. And so I think this is his way of using the vast wealth that he's accumulated to throw his weight around. And if he seems to be sort of a libertarian, free speech enthusiast, the best way to push those feelings forward is to take a lion's share of what has kind of been the battleground for that kind of free speech, which is Twitter, and affect some change. So I think it's super interesting. It was the last thing I saw before I walked in. Didn't have it for a whole day, so I spent a lot of time thinking about it. And I just think it's an interesting move. A lot of these billionaires accumulate a lot of wealth, and then they just kind of don't do anything with it. I think that this is an interesting use.
All right. Thanks, Tom, for those thoughts. I agree with you. I think it is a interesting way to affect the narrative that Elon Musk can do. And I think that you're seeing an impact on the Twitter stock price this morning. It's up about 5% pre-market. It does take the idea off the table that Elon Musk will come in, buy a big stake, and then immediately sell it after it goes up 25%. So he's in for a longer time period now, which I think is in a good makes it a good thing for if you're a Twitter shareholder. Moving on to a revisit of the Russia-Ukraine situation. The EU and the US are getting more aggressive on the sanctions that they want to propose. Zelensky is going to address the UN Security Council later today. The EU is looking at putting more sanctions on Russia, on 10 billion euros of exports and 5 billion euros of imports. Of course, if you have more restrictions on exports to Russia than imports from Russia, then you're going to increase the current account surplus that Russia has, which you could argue is counterproductive. They are banning exports of semiconductors, high-tech machinery, LNG extraction technology, and other equipment to Russia. That's the 10 billion euros. And they're talking about banning 5 billion euros of imports, including coal, including wood, cement, rubber, chemicals, caviar, and vodka. So that's what they're looking to limit in terms of imports into Europe from Russia. The EU nations continue to be significantly and deeply split on the next steps here. Ursula Von Deland, the EU Commission leader, she's going to visit Kiev later this week to meet with Zelensky in a show of support for the country. And the EU continues to look at evidence for potential war crimes. It's interesting that von der Leyen believes that Kiev is safe enough that she can go and visit Zelensky in person to that city. Meanwhile, the US is promising more sanctions coming later this week. This comes as, obviously, we saw those horrific pictures and images from over the weekend of the outskirts of Kiev. So that's where we stand on the Russia-Ukraine situation. It looks like more sanctions are coming, although as a percentage of trade, it really doesn't amount to a whole lot. And Hungary and Germany still continue to be off the table in terms of proposed sanctions on oil and gas. And you do need unanimous support from the EU countries in order to do that. And right now, Germany says we're not going to sign up for that right now. So it looks like they'll just continue to taper at the margin the ability to do trade with Russia. Shifting gears, the state of freight. I think that this is something we haven't talked enough about over the last couple of weeks, but it really has come to a head in markets over the last week or so. And that is truck rates are declining substantially. And I'm going to share this with you. This is a industry site that we like to look at. It's the DAT board. So this is what some truckers can use in order to identify how much they should bid for a contract or a spot rate. And so if you go down here, you can see the national average rates for dry van, and this is your retail. And so this is excluding fuel, and you've gone from $3.10 per mile in January to just $2.90 here in April. So it's really fallen off a cliff. What's interesting is that while dry van has declined significantly, flatbed rates have actually increased. So they're up to $3.44. From $3.12 in January. This is a seasonally strong period for flatbed. You don't want to go strapping up a flatbed rig in the wintertime. It's just a lower seasonal period for them. The rates are strongest in the summer when they're really going, and you see a lot more of them on the road. So that's where we stand on the markets. But the dry van situation is causing some consternation in the market. And that's due to a few reasons. Number one is that we've actually unleashed a ton of capacity on the market. You have 114,000 new operators who are bidding on the spot market. And that is because they're turning over so much faster than they were this time last year. This time last year, there was congestion. It took forever to unload. It took forever to load. And this time we've improved the supply chain so much that we've actually unleashed more capacity. The trucks were always there. The drivers were there, but the drivers were being held up. The trucks were being held up at drayage, at the retail location, just trying to get unloaded. And we're not seeing that nearly as much anymore, which has actually unleashed a lot more capacity. You increase the supply, you lower the price. So that's one issue, but we're also seeing lower load demand as well. And that's coming from the retailers. And part of that is because the retailers have been so concerned about the stoppages in the ports that they've really brought in inventory a lot earlier than normal. Late April and early May is always going to be a seasonally soft period for dry van. For the year, and we may be having that seasonally soft period earlier than normal and magnified because all the retailers were so concerned that they wouldn't actually be able to get inventory that they accelerated bringing that inventory earlier. And that's something that we have seen from retailers as well. This coupled with the concern about gas prices and concern about Russia, Ukraine, and the denting of consumer confidence has hit some of that, and it's been a perfect storm here in the last week or two in terms of trucking. So what you've seen is a lot of trucking companies have actually seen their gross margin deteriorate substantially. I mean, some of these gross profit numbers are pretty staggering, going from something like 48 cents down to 14 cents in just the last few months. So that's a gross profit number, and that's on a per mile basis. So things definitely cooling a little bit in trucking land. Part of that's additional supply, part of that's lower demand. Part of that lower demand is seasonal, and it's just difficult to understand what is the true nature of what's going on in freight. And we're going to talk a lot more about this at the macro presentation on Tuesday. But I wanted to address it today because we're going to start seeing headlines of where freight goes, GDP follows, and where GDP goes, recession follows. And so that may very well be the case. And we're looking at that as a plausible rationale for why we're seeing what we're seeing. There are other reasons as well. And so we're trying to decipher what probabilities are most likely. So we have that going on. We also have the interest rate situation going on. And I think this is definitely playing a significant role as well. We had European economic data that came in this morning that was better than expected, significantly better than expected, especially on the services side. But I'm curious, Tom, what are you seeing in terms of interest rates and how that is impacting buying decisions, investment decisions, and potentially what the path is going forward?
I mean, I think we're just on what I think is going to be a secular raising cycle. Jamie Dimon had a lot of comments yesterday saying that we're basically in a situation where the Fed's going to have to be pretty aggressive, and that, you know, he hopes for a soft landing and that we could have potentially years of great growth to come should we get the hike cycle correct. And I think that's really how we have to look at it. Right now, you know, each time we look at a bond, we've got to look, you know, does this have some sort of cushion built into it because rising rates is going to hurt the principal value? You know, we're going to get maximum yield for this, even if it's going to price poorly in the short term. I think opportunistically, you know, we can buy a lot of shorter bonds, we can buy a lot of longer bonds, and we're not really giving up much in terms of yield. And that's very beneficial for just, you know, as bonds roll off, we're getting better yields than we have in a couple of years. And so even though they're, you know, rising rates, you know, every time we replace a bond, every portfolio is making more money than it was before, provided those bonds were bought in the last, call it 5 years. And so I think that's advantageous. I think we can really just start to generate a lot more income on the portfolios as bonds roll off. So even though it seems bleak with each bond that we buy to replace an old bond, we're getting a little bit stronger. And in terms of credit quality too, we're finally starting to see a lot of improvement. I mean, even things like New Jersey has for a long time been considered probably the second worst state to invest in the US behind Illinois. And they were upgraded from BBB status to single A this morning. And that's at the state level. So everything underneath them that feeds through the state got upgraded as well. And we have a lot of exposure there. And I like New Jersey. I think it's sort of been miscast for the last 4 or 5 years. I think they've been improving from a credit standpoint for a long time, and that's finally coming to fruition. And so, you know, you can basically say, hey, we were buying these bonds that, you know, had credit quality that the market at large did not agree with, and now they've been upgraded, and now we're back in line. And that can show a price improvement despite the fact that bonds are selling off. But it also means that even though prices are going down, credit quality is improving. So you're getting better, cleaner bonds at lower prices going forward. I think it's beneficial. I think that we just need to get to a point where rates are normalized. And as we go along, we're just going to have to pick the best possible bonds in order to get the maximum return on that. But in the short term, it's going to be a little bumpy. But I think that, you know, ultimately, if we could generate 4 or 5% off the portfolio that's supposed to be the ballast of the portfolio and not 1% like we've seen over the last 2-3 years, you know, that's just beneficial for everybody. It's beneficial for those who are retired. It's beneficial for those who are trying to accumulate money. It's just a better situation. And if we can double that up with improving credit quality, you know, across the purchases we've made, then even better. So it's been a tough year so far for bonds, but I think that, you know, the thing about bond losses is as long as you hold to maturity, it doesn't really matter what the price fluctuations are in the short term. And so we just need to keep that in mind. as we go forward and continue to buy the best possible bonds we can.
Yeah, thanks, Tom. I think that's a great way to look at it. In terms of my view on inflation and interest rates, I do think actually we're starting to see signs of deflation, or at least disinflation. We're seeing truck rates. I mean, we just talked about it. Dry van rates are down 5% in a month. You have used car prices down 4%, and that was in March. I would expect that to be down even more in April, and that's on a month-over-month basis. So you can multiply that by 12, and that's your annualized rate of disinflation. So things that were pretty frothy are coming back to earth faster than I think we might have thought. Offsetting that, you have the higher oil prices. Well, oil prices topped on March 8th at $124 a barrel, then now at 104. So that's come down as well. And so when we're looking at how this inflation is manifesting itself, there's going to be a tail to it. There's going to be a lag as the oil impacts the chemicals, impacts the plastics, impacts everything that we consume. But in terms of the impetus of it, we're seeing the impetus of inflation begin to decelerate pretty substantially and in pretty significant ways. And it's still early days in that regard, but I wouldn't be surprised if we start to turn the corner on inflation here and potentially even this month. And when we do that, I think that you take some of the pressure off the Federal Reserve. And right now, the Federal Reserve or the market is expecting 8.6 interest rate hikes this year. We've had one. I would take the under on that. And I think that the Fed is going to relatively quickly take its foot off the gas if it starts to see inflation coming back down in a reasonable fashion. Tom, any thoughts on that? And maybe just one or two anecdotes on the Masters, and then we'll close out.
No, I agree with you. I think that inflation, knock on wood, I'm of the opinion that inflation has peaked, and then we're going to have a glide path lower towards the second half of the year. And I think that in my mind, I'm looking at 6 hikes is kind of the bogey I think we're going to get to. I think we're going to get some double hikes early, and then I think we're going to see a little bit of a deceleration there. That's sort of how I'm viewing it right now. Obviously, those things could change. There's a lot going on in the world that could change that very quickly. In terms of the Masters, it seemed exceptionally crowded compared to the one other time I went. Everybody was pretty hyped for Tiger. If you look on if you get the official Masters emails, which I do, if you look at the pictures, on the 4th picture in the very top right corner, you can barely see me looking at Tiger. You can see the top of my head and my sunglasses, so no big deal. I was on the website this morning, but it's awesome. But big, if you're going this year, I have some disappointing news, which is they have discontinued the peach ice cream sandwich that everyone knows and loves from a few years ago. So I was very disappointed in that, but otherwise it's the best place on earth, and I hope I get to go again. No guarantees on that. As everybody knows, it's very difficult to get in, so I was pretty thankful that my buddy got me a ticket, but it's just the best, man. I love it.
So if anyone knows anyone, I guess that's an invitation, a self-invitation from Tom.
Yeah, exactly.
All right. Well, thanks everybody for joining us. We'll be here right back bright and early tomorrow at 8:30, and we'll see you there. Bye.